Good morning, everyone. Lovely to see so many of you on the line today for the monthly Property Master webinar. Just chatting to Angus and our guests. We've been doing these now for nearly 18 months. Time really flies. It's a chance really to answer your questions and to keep you, our clients, up to speed with what's happening in the buy-to-let market. The theme for today is tax, and in particular, HMRC's scheme for making tax digital. And as I just put in the chat box, we have hot off the presses some news on what is going on. So turns out this is particularly well timed. Our special guest for today is James Middleditch. James is a chartered tax advisor. He works for Edge, which is a tax consultancy we've done a lot with. Fantastic outfits, and we're pleased to be doing more with them. So welcome, James.
Hi, thank you, Madeline.
James is going to be answering your questions on making tax digital and any other tax related questions you might have. He's an expert on landlords and tax, and we know that's a issue that so many of you are interested in, and we can see that from the numbers of people on the line today. So if you have a question for James, just go to the ask a question at the bottom of your screen. You can pop it in there, or indeed pop it in the chat box, and I'll monitor the chat box as we go along. Also, any questions generally on buy-to-let and buy-to-let mortgages? As ever, we're joined by Angus Stewart, Property Master's Chief Executive. Good morning, Angus.
Good morning, Chris. Good morning, James. And good morning, everybody.
Before we start, Angus, as usual, can you just perhaps kick off what's going on? And also, listening to the radio this morning, hearing whilst the Bank of England kept rates on hold, there's beginning to be some chatter about rates possibly going up in the spring of next year. But, what are you seeing in the mortgage market at the moment?
Well, there's always been chatter about rates moving. And I think, we've had a historic low interest rate time period. And that's what we're seeing in the market. I mean, interest rates for buy-to-let and residential are at a all-time low. And there are some brilliant deals to be had if you fit the specific criteria for some of these lenders. So there are a lot of headline rates out there. I think the thing I should counsel many landlords is that you won't necessarily get the headline rates. They are quite niche in terms of looking for people who've got no arrears problems in any way. They often won't be available to people doing it through limited companies or HMOs or any of the other things which we know landlords like to do. So you may see some headline rates out there, but criteria and affordability are likely to mean that those rates aren't available for the vast majority of landlords. So please don't be fooled by something that looks around the 1% level. It's probably not going to be available to you. What's happening in the market? Well, we've had some record highs in terms of price growth over the last year or so. I mean, I'm hoping that that's starting to tail off a bit with the end of stamp duty, but there's still significant demand. What we're finding is that people are still willing to pay over the odds for properties. So what happens in reality is that somebody might pay a inflated asking price or even above the asking price to get the property of their dreams. And then when it comes to the valuation, we might find that the valuer says, well, it's not quite worth that much. There's a bit of froth in this market, and therefore, we have sometimes challenges in terms of the LTV or valuation or affordability calculations, meaning that the landlord can't get quite as much as they thought they were going to get in terms of that property. And what's driving this? Post-pandemic, we're getting more and more people wanting to move out of the cities. They want to have a better work-life balance. I think most companies, although people are going back now to offices, maybe only a couple of days a week. So it's a change in relationship between work and home and balance and where people want to live. And so we're seeing that places with gardens, places with a bit more space, places where somebody can have a home office are more in demand. And that's changing the shift in terms of what's happening there. I mean, London prices, dipped a bit, and certainly rentals dipped a bit. There's a degree of stabilisation there that we're seeing, but still, I think it's the stuff out of London, and in terms of better yields, it's places northwest, northeast, and in the Midlands where you can get your better yield. So, despite end of furlough, we've got the queries about the sort of £20 universal credit. I mean, at the moment it's disappearing, but let's see what happens. There's clearly a lot of pressure on the government to maintain that payment. I think one of the other challenges I think we're all going to face is sort of higher energy bills. That looks a little scary. I mean, I know my own one is going up by a third in terms of the rates I can get, so that's going to affect everybody, be it rental people or landlords themselves. And I think we're going to see some continued pressure for some segments of the market in terms of affordability of rent. Now you can evict tenants slightly more easily than you could when it was all planned during the pandemic. It's going to be interesting to see what happens there and how our landlords work with their tenants through what might be a more difficult time in some ways than during the pandemic itself. So lots of things going on there, and as we've talked in previous sessions, some of the changes on EPC regulations that are being proposed, that from 2025 that you need to be a minimum of a C to be able to rent your property to new tenants, 2028 if they're existing tenants. We've got the COP26 coming up in November. It's going to be interesting to see. Clearly the UK government's taking a lead there and is probably going to be pushing hard on some of these changes, and that is going to have a knock-on effect on landlords. And as we sit here today, we don't know what help is going to be available, and what all the help got pulled a year ago, and I think it's very unfair for landlords to be expected to make these changes, which could cost thousands of pounds, without some government support as we go through this. So I think that's going to be an interesting space to watch over the next few weeks. But as ever, we'll keep our landlords informed as news changes and as stuff comes through. But so anybody, if you've got any questions on the general buy-to-let market, feel free to put those in the chat. This session is specifically about making tax digital, and I'd love to hear from James and understand exactly what's happening and what this hot off the press news is, Chris.
Yeah, thank you very much, Angus. As you were going through all of these issues, it made me realise there's just so much happening in this space at the moment, and you guys on the line today, what we're trying to do is to make it easier for you to find your way through this kind of thicket of new legislation, new regulation, and so on that's happening. And yeah, as Angus said, hot off the press, James is going to bring us up to date. My first question was going to be to James, what exactly is happening with making tax digital? And I thought he'll run through the timeline and we can inform you all. But now he's got a bombshell really. So what is happening now, James?
So what's happening is, as of about 4 o'clock yesterday afternoon, the whole thing's been delayed by a year. So it was going to be the case that making tax digital, that income tax, which is landlords owning properties, sole traders and partnerships, was going to be in place from the 6th of April 2023, so just around the corner. For landlords, it's now been delayed until April 24. Sole traders, it's been delayed until April 25. And partnerships, we simply don't know. There's a statement saying that it's been delayed and the government will get back to us and let us know exactly when it has been delayed too. So very helpfully, this came out quite late yesterday, together with some new legislation, talking about how this is going to work and what returns are going to be required for making tax digital for income tax. So we're in a slightly strange circumstance in that everything's been pushed back by at least a year, but we now have more detail about how it's going to work than we've ever had before. Now, obviously, over the course of the coming year, it's quite likely that's going to change. I guess probably the main question for a lot of people is why has this been delayed? And it's going to be a mixture of pragmatism and the desire to achieve the tax yield that the government's predicting. So HMRC have come up with some absolutely extraordinary figures about the amount of money they think is going to come in by virtue of making tax digital. They think there's going to be an increased tax yield of 400 million in terms of income tax within 5 years. They've also made some statements about what's known as the tax gap. So the tax gap is the difference between the tax that the government collects and the tax that should be due. The government is notoriously bad at collecting tax from landlords. They've got the land registry, so they know who owns almost every single property in the country. They've got the electoral roll, so they know who lives in almost every country in the property, and yet for some reason they've never quite been able to work out which ones are renting. So, which I would suggest possibly the work experience for you can do with a spreadsheet in the afternoon, but you know that's government. So
they're kind of convinced, are they, that there's, you know, maybe not a pot of gold, but certainly sufficient money down the back of the sofa here that they're missing, and that's what they're up to. Is that kind of right?
90 million, we think, is unreported from landlords every year. Just for people who don't declare their income tax. 8.5 billion, the revenue think, annually, for various reasons. Now that might be criminality, that might be errors, that might be differences of interpretation. Tax is a matter of law, but there is scope for interpretation of the law. Otherwise, you know, we wouldn't have a judiciary, we wouldn't have a tax revenue, and we wouldn't have legal ourselves, because it simply would be. So there is potentially quite a big yield. I think probably the government's suggested increase in yield from making tax digital is, well, bluntly, a nonsense, or at best, you know, ambitious. But we never know.
Yeah.
So I should add, there is a pilot scheme running at the moment. It is actually possible to sign up for making tax digital for landlords already, if you're inclined to do so. There is a condition of this, which is that you can have no source of income other than rental properties or sole trade.
Yeah, that was one of the things I wanted to ask you about. But if we go back, James, so what would landlords need to do? Would they be required to file every quarter as opposed to like at the end of the year?
Yeah, absolutely. So this was introduced by George Osborne back when he was Chancellor, and he stood up in front of Parliament and he made this grand statement and said, I'm abolishing the self-assessment tax return, and you know, machines are going to do it, and it's going to be much better. So at the moment, you report unless you're a sole trader or partnership, you report your income for tax year by the 31st of January of the following year, and you pay your tax then. You might do wrong payments on account, in which case you make one payment in advance in January and one in July. So there's a fundamental delay in terms of cash flow. The government's waiting up to 10 months to get their money. Under making tax digital, what's going to happen is everyone's going to be required to keep digital records. And digital is a broad spectrum. That doesn't necessarily mean Xero or similar software. You can still use spreadsheets. You need what's known as bridging software to submit the return from spreadsheets, but that is permissible. But the government view that the days of the shoebox full of receipts, or the carrier bag of receipts that we get in January from everyone, is over as far as they're concerned. They made some very, very grand statements about the fact that nobody was using spreadsheets and nobody was using paper records, which we all know to be incorrect. Under the system, you have to keep digital records. So at the moment, you're only required to record the date, the amount, and the type of the transaction. So on the 5th of January, rent received £1,000. On the 6th of January, mortgage interest paid X amount. Those records have to be kept in a digital system, and you have to submit 4 quarterly returns, which purely tell the level of income and expenditure. Now, at the moment, the rules and the legislation, I've got legislation next to me, I was reading it late last night, say that the system is going to give you a running total of how much tax the government thinks you owe, but you won't have to pay it. You just have to make, look, saying the sound isn't great. I'm just going to move in closer to the screen and see if that helps.
Yeah, sure, thank you.
So it's the deep voice as well, you know, it doesn't help. So 4 quarterly returns, it's going to give you a running total. At the moment, you don't have to pay tax until the 31st of January, so nothing's changed. After the 4th quarter, you're then required to submit a 5th return. That's an end-of-year summary, which summarizes all of the income over the previous 4 quarters and makes any accounting adjustments that are required. for instance, accruing for the fee which the accountant will charge you later, or so forth. And then by the 31st of January, you've got to submit a sixth return, which ties everything together, includes all your other income, your pension, your salary, your benefits in kind, trust income, whatever else, claims any relief, and then finalizes the amount of tax due. So a pedant might suggest that this has gone from one tax return to six. But the government disagree. It's for each business, the legislation says. Now, I spent a bit of time reading what constitutes a business, because perhaps if I have, I don't know, maybe I've got a bunch of properties in London, maybe I've got some in the country, and maybe I treat those differently. Maybe I account for them differently. Maybe I've got some commercial left as well as residential, and I keep the books separately. Under the letter of the law at the moment, the Income Tax and Trading Act 2005 considers a property business to be one of two things. One, all income from the exploitation of land and buildings in the UK. Two, all income from the exploitation of land and buildings outside of the UK. So if you consider a situation where I've got rental properties in the UK, and let's assume Scotland's still part of that at the time, and I've got a rental property in France, I've now got an extra 4 returns that I need to submit in respect to the French property, plus an end of year declaration. So I've now gone from 1 tax return a year to 10. Now, the good news is HMRC put out a big statement yesterday where they said they've gone through, we've run the numbers, we've come up with how much we think this is actually going to cost people, and they think it's going to cost £330 per landlord to transition, and there's going to be additional compliance costs of £35 a year. No, I know I don't do returns for £35 a year.
It doesn't seem a lot of money, James, really.
Well, a £0 costs me £30 a month. So there's going to be a bit of transitional difficulty. Once it's up and running, it won't be so arduous. Nothing will change in the short term. In theory, you'll just have to do your bookkeeping as you go along through the year, rather than putting everything in a bag and then pulling it out in January. Yeah, I mean that might be a useful discipline, but it does sound like added work. I mean, Kashif has a question about the software. Do you know a software which will be able to allow different share splits and prepare 2 tax returns to submit by making tax digital? So as yet,
a little bit like the scenario you were just describing.
Yeah, absolutely. So so I guess the question is, if you own property jointly, say with your spouse, then that property would be, or the income for that property would by default be attributed 50-50 to each of you. Now at the moment, there isn't any software that can do it. A number of software providers are working on it. But there's nothing in place yet. What we might end up with is something a bit like making tax digital for that, where the software sort of puts all the numbers together and then spits it into a spreadsheet, and we use another bit of software to submit that return. But as yet, it's not in place. We've got a whole extra year now where that will be developed. But obviously, a lot of software companies working very, very hard to try and put this in place. Because obviously there's a lot of money. The first one you can do it is going to be rolling it. So that's fine. I guess for now, the message is really to get used to keeping records, and to get used to updating them regularly. You've only got to do it once every 12 weeks. There are various bits of software that will do it either through an app on your phone or through a desktop, or even just a simple old-fashioned 3-column cash book in a spreadsheet. So you record the rents in, you record the expenses, and then you analyse them what they are. Is enough.
I mean, for making tax digital, I don't know whether I got this right, but aren't there particular software providers you're supposed to use, or they're guiding you towards?
So no. So at the moment, anyone, so there's what's known as an API, an application interface, that connects into HMRC software. So there aren't specific endorsed ones. In theory, anyone can produce the software. and it be signed off by the government, in theory, there will be free software providers, and HMRC have been quite firm in stating this with their advisory document that went out yesterday. But quite who those free providers are, we don't yet know.
Okay.
So it's all to play for over the coming weeks. I would add there's a slight complication to this. If you're letting property to a limited company, at the moment the limited company isn't within the scope of this, so it carries on under the old rules. If you're letting property under a partnership, and that's a formal partnership that's been registered with HMRC, so you've submitted an SA 400, an SA 401, you file a partnership tax return annually, an SA 800, and that's not the same as just saying we're operating a partnership. It actually needs to be registered and filed. Technically, that's not within the scope of this. Technically, that's in the group of property businesses that's deferred indefinitely at the moment, we assume to 2025. And that there are very good reasons why you might be operating a property under a formal partnership, not least of all, it lets you allocate the income in disproportionate amounts. So you can say 20/80 or whatever, as opposed to a jointly held property where it would default 50/50 for a married couple. So that's slightly odd and falls outside of the net at the moment. I'd be interested to see what happens with that over the next few weeks, but I suspect perhaps that hasn't been thought about in great detail.
No. I'm sure they'll get to it. I mean, Angus, hearing all of this and the added workload that's going to be created for landlords, what do you think the impact might be on our clients?
It sounds horrific, doesn't it? I mean, going from 1 tax return to 10, and then if you've got foreign property as well, even more. I mean, it looks as though it's not really been thought through in sufficient detail for the couple of million landlords out there. In terms and many landlords now, I mean, certainly many of our customers will have property in their sole name. They may have stuff with their spouse. They may have stuff with a business partner, but not as a formal partnership. They might have limited companies, and they will have property under all these different guises. And trying to work out how to do that tax return when you've got all those different elements at different times, and then you may have a holiday let, which again is under different tax rules, and you might have one that's overseas, which is under again slightly different tax rules, and trying to work out in a simple way, and if the government's saying, well, you can do it for 35 quid a year, I mean, somebody somewhere is on a different planet to me.
So it is going to be very, very challenging, and particularly for people with complicated affairs. But I do think after the initial transition, I would add, I'm very, very cynical of this sort of thing. I don't necessarily think the government should have that level of detail about people's lives. While I go and post every detail of my life on my social media feeds for everyone to see. I find it difficult. It's going to be, the first year is going to be challenging, particularly for people with complicated affairs. It might well be worth trying to get some sort of sense of the system in place now in advance, just so you're prepared and you're not straight in. I think the good news is they have said that they're not going to charge any penalties for the first year. So I suspect, by virtue of that, we can infer that perhaps HMRC think this is going to be absolute chaos for a time.
Yeah,
exactly. It probably will be. The penalty regime is changing with it. So we had we're under self-assessment. You get your return late, £100 penalty. Wait a couple of months, £10 a day penalty until it's £900, and then wait a couple of months, 5% or £300 on top again as a penalty. That's been the penalty system since about 2007, 2008. They're going to be changing it, so it's going to be on a points system. So a bit like your driving license. So you get something wrong, you accumulate points. If you have a certain number of points, then you will receive a penalty. Now, potentially as a percentage of tax, which is a bit more like the way the VAT penalties work, that can be quite brutal for higher earners.
Yeah.
So I think you're suggesting here, James, is that there will be a penalty system which could be even more onerous than we've seen with the self-assessment side. And what you're suggesting is, despite the fact that we've been giving another year to get ready for it, A, we need to be starting to think about it now, and B, it's probably a good thing we've got this extra year to get ready for this.
Yeah, that,
looks like
absolutely.
a very significant transition.
Absolutely. I mean, I've been doing this for a long time, and I think something you learn in tax very quickly on is whenever a chancellor stands up and says they're going to simplify something or they're going to make it easier for people, what they really mean is they're going to put the tax up, and that is what's going to happen. So ultimately, penalties will be harsher for repeat offenders. What will happen is at the lower end, if you just happen to miss one return and forget it, you won't be penalised anymore. Whereas currently, somebody who forgets their return once is charged £100 immediately. Someone who does that every year is charged £100 every year. So there isn't really an escalation of impact for repeat offenders. And we've all got one or two clients. There are one or two who are late every single year. So I guess in a way it cuts down on that as well.
Got a couple.
Sorry.
No, as I say, just got a couple of questions here from Kashif is asking, if a person has a buy-to-let abroad, and you alluded to that earlier on, will they have to pay tax in the UK and abroad? I guess this doesn't change.
So,
Yeah.
Right, so it depends on where you live, it depends on where you're domiciled, and it depends on your resident status, and it depends on the terms of the double taxation treaty with that particular country, if there is one in place. So, for instance, Gibraltar, we only actually had a double taxation relief treaty with that a couple of years ago, even though it's basically part of the UK. Very broadly, if you are UK resident and UK domiciled, you are taxable upon your worldwide income and gains on a rising basis. So that is, as you earn them or sell things, you are taxable in that tax year. If you are non-UK resident, then you are taxable only upon your UK source income. And buy-to-let, income from land is a classic. There's what's known as the non-resident landlord scheme. You are taxable on it here. And if you don't fill out your tax returns, your rent will get paid to you net of tax. So if I have a property overseas, then that income will most likely be taxable in that country as well. There are very few jurisdictions where the double taxation treaty actually gives taxing rights to one particular state. So, if I have a property in faraway land, it says, in terms of the treaty, say only taxable where the building is. But that's very, very few. Where you do suffer overseas tax on your rental income, and you are UK residents, you are entitled to a credit against your UK tax liability for the overseas tax that you pay. So there is some relief. It's known as double taxation relief. It's given in one of three ways, depending on the particulars. Of course, it becomes a bit of a pain because in the UK, obviously, our tax year runs from the 6th to the 5th of April. Overseas, there are a lot of different tax year ends. Quite a few of them March, quite a few July, many December. So you have to sort of apportion it across the tax years as well, which is great fun. It's like going back to exam day. So fun for me anyway.
So it's going to depend to a degree then, Kashif. Angus.
It will, but you'll get relief in the UK for any tax you paid overseas.
So how would that work in a making tax digital environment? Let's say I own a buy-to-let in France or Spain, but I'm a UK resident. Am I reporting under this new quarterly regime everything to do with that buy-to-let in France or Spain? At what point do I pay tax to the country it's in, and how do I then net it off? And have I paid money out to the UK government before I've received anything back?
So you're reporting it quarterly, in line with quarters of tax year here in the UK. You're then submitting a summary return shortly after the end of the tax year, and you're then claiming that double taxation relief in your end of year return that's due in by the 31st of January, and you've then got to pay that tax by the 31st of January following the tax year end. So again, a parent might point out that is what we do now, only with 5 additional returns. There is a caveat to this. I would be very, very surprised if a day doesn't come when a chancellor stands up and says, "Do you know what? We'd quite like you to pay your tax on a quarterly basis." So that
And
is
we have heard that from time to time, haven't we?
Oh yeah, and that will be the end goal of this. It's about
well, in the same way they've changed the payment of capital gains tax, you can see that they are likely to want to move this to a quarterly basis, because from a cash flow, it makes a huge difference to them.
Yeah, absolutely. And capital gains tax was a particular problem because you would for CGT you sell a property when you exchange it, not when you complete. You would exchange on the 6th of April, you'd get your money somewhere in May, and then we'd go through the tax year, we'd be into April the next year, and then we'd be into January the next year. And what the government found was that you'd spent all the bloody money by the time that the tax was due. So that's what prompted that one.
That's what prompted that one.
Yeah.
Question here from
turning around going, "I can't pay, but have you seen my lovely car?"
if only. Question here from Anthony, James, for you. If a property is owned jointly by husband and wife, and I guess that this happens a lot, doesn't it? Will both owners have to submit a separate tax return 50-50, or one can do for the total, disregarding the tax disadvantages this option may present?
Right. So yes and no is the answer. So the legislation which came out yesterday, read through it, it's all been very exciting. It's based on a person's qualifying income. So the obligation to file under this regime is that you have £10,000 of qualifying income, of rental income, and that is the turnover, not the net. That's just the rents received. If you've got more than 10,000, you have to file under Making Tax Digital. Now, by default, under the Income Tax Act 2007, where spouses own property jointly, the income from that property is taxable 50-50, regardless of the underlying proportion of the ownership of that asset. So I could own a house 20/80 with my wife, I'm still taxed on half of the income. So you're going to end up with some weird situations where you have spouses who own a property jointly. One of them has another rental property in their sole name, and spouse A is going to be below the £10,000 limit. Spouse B will be over it. So only one of them will be reporting. If they're both over the £10,000 limit, then yeah, you're both filing quarterly returns. You're both filing the end of year return as well.
That 10,000 is quite an important point, actually, because that is the threshold when this kicks in, isn't it? And as you say, it's rental income, it's not profit.
Absolutely, and that's not a lot of rents to hit 10,000 either.
No, quite. What about if you have other sources of income? You're self-employed, or you have a pension, or whatever.
Right.
I mean, is that yet another load of tax returns? How will that work?
It depends. So if you're a sole trader, if you're a partnership, then yes, you've got another load of quarterly returns when that eventually kicks in. If it's just pension income or employment income, then that goes in that final annual return due by the 31st of January. Now, the idea of this is that eventually the government systems will suck all of this information in into a central pool. So if you can sign up for what's known as a personal tax account now. You do it from gov.uk. It's worth doing if you haven't already. I would encourage anyone to do it. You can see your national insurance records, so how close you are getting your full-pay pension. You can see your P60s on there already. So some of this information is in place already. Pensions, employment, we can all pull that information in from the revenue now. They are talking about bringing bank interest and investment income into it as well. And eventually offshore. So the theory is that we'll be reporting our sole trade income, we'll be reporting our property income, but deep thought, the machine will be sucking in everything else from banks and employers, and then dumping that into the return for us. Which again, I take umbrage with from a personal privacy point of view. But that's perhaps me living in the past.
Yeah, it does seem to be the way the world is going. So at the moment, what our landlords need to be doing is getting themselves in a position where they can have everything in front of them every quarter. Is that the best thing to be doing?
And, you know, as a tax advisor, as an accountant, I'm constantly saying to people, it is easy if you keep your records regularly throughout the year. And it is not uncommon for someone to entirely miss the fact that they haven't received the rent. Or to come to us at the end of the year and go, these are all of our expenses, and then we look back to last year and go, well, it can't be. I know it's a flat, there's no service charges here. Where is all this information? You're overpaying. You're declaring too much income. So it's a bit of a mindset change, is all. But get sensible systems in place. QuickBooks is cheap. There are cheaper options out there. Spreadsheets are free. If you can find stuff in.
Yeah. Angus, what about on the lenders' side? I mean, do you hear about this issue from lenders at all? Because if it's going to be an additional burden on landlords, it's going to increase their costs. Obviously, that's going to impact on their ability to borrow and service debt and so on. Is this coming up yet?
Not yet, I'm pleased to say. I've not heard any lenders talk about this so far. I mean, clearly lenders are interested in ensuring that people are paying the right level of tax. They ask to see tax returns. I guess this is, in due course, other elements that they're going to want to have visibility of in due course when they're doing mortgages. We quite often have to guide clients that they need to fill in appropriate tax returns. They need to go and talk to accountants to do that, especially if they've accidentally forgotten to report revenue over the past few years, and to do something in a retrospective way. Sometimes happens. I mean, as I'm sure you appreciate, Ben, people accidentally forget.
It is. There's what's known as the Let Property campaign. It is HMRC's longest running disclosure facility. Undeclared rental income. I've got a chap I'm dealing with at the moment. He's got 20 properties in the UK. He's had 5 in America. He's had another 5 in France, and he hasn't declared any of it for 30 years. And the tax man has suddenly called him and said, "We think you might owe us quite a lot of money."
Wouldn't want to be in his shoes. So.
No.
Yes. Anyway, I mean, I think we all know that we end up having to pay tax. I think the issue for our landlords is how do we make this change as painless as possible? And I can see that at the moment it could be quite onerous. But the other thing you're saying, James, is that you don't need to keep any of the receipts, or you need to be able to provide receipts on request if there was an audit.
So that's a good question, and I've just seen a question from Kashif going to come to as well, because that's also a good one in the box there. As a taxpayer, you have a legal requirement under the Taxes Management Act 1970 to retain copies of your records for a certain period of time. For self-assessment, it's 1 year and 10 months after the end of the return. For a business, it's 4 years. For a company, it's 6 years. So you are legally required to be retaining that information anyway at the moment. It's just that it keeps falling in the shredder because nobody knows. Now, under the regulations that came out yesterday for making that digital, you are required to keep that information, I said, the amounts of transactions, the type of transactions, the date of transactions, in line with the period set out under the 1970 Act. So actually, you've got to keep those digital records for 4 years or so. Now, digital tends to be forever, so it's a bit easier to keep. Certain banks, particularly high street banks, are very, very diligent in destroying all records once they hit the end of that retention period. Kashif has asked, do we know if the quarter end will be the 5th of the month or the end of the month, because the tax year is running from the 6th to the 5th? So we do. So by default, it's running up to the 5th because it's in line with the tax year. Why does the tax year start on the 6th of April? The answer is because New Year's Day used to be the 25th of March. And when we changed from the Gregorian to the Georgian calendar, we were 11 days out, hence it became the 6th of April. So at the moment, under the legislation that came out yesterday, there is an option to elect to prepare your accounts to month end rather than to tax month end. So you can go up to the 31st rather than the 5th. It's a manual election that has to be made. At the same time, the Office for Tax Simplification are consulting at the moment about changing tax year end altogether. So there is a debate going on as to whether we should move it to the 31st of March or the 31st of December. So that's all to play for. But for now, yeah, you can do either of those quarters. Making Tax Digital is coming up now, but we've known it's coming for quite a few years. It's been in for VAT since 2019. There's quite a lot of measures that have been put into legislation over the last few years under the guise of simplification, which really and truly are actually Making Tax Digital measures. And amongst those is that for property income below a certain level, the default way of taxing it and reporting it now is on the cash basis. So when you pay or receive money rather than when it's due. So that is in preparation for this Making Tax Digital. Because if somebody pays you a rent late, it won't matter, it just goes in when they paid it. Rather than actually following the principles of accounting and accruing it to the period it relates. There is a theme with Making Tax Digital from the government, which is that machines can do a better job than you, which is why we're having to change the rules of reporting property income, because the machines can't cope with basic accounting, which, by the way, haven't changed for 800 years, and we were doing with an abacus. But there we are. What do I know?
Well, that's progress. Don't forget, guys, if you have any questions, please put them in the chat box or on in the ask a question box. I mean, James, we've talked a lot about, and Angus has as well, how onerous this is beginning to look. What do you think are the other pitfalls landlords might face as a result of moving to this new regime? What do you expect to see, for example, from your clients?
Well, bluntly, at the moment, I have to do a tax return once a year. And it is a struggle to get information from clients once a year. And now I'm going to have to do it 4 or 5 times, which is going to present certain challenges, particularly from the repeat offenders. The risk is that if we've been perhaps a little bit laissez-faire with getting information in, and that attitude continues, we're very rapidly going to ramp up into that penalty system where suddenly you're getting much, much higher rates of penalties. And I suppose the main risk is preparation. If you leave it to the last minute to actually start keeping regular records, if you don't get into that habit, then it's going to be a very, very abrupt change for a lot of people.
Yeah, and a painful one by the sound of it.
Yeah, absolutely. And from a purely selfish point of view, imagine the time it's going to cost accountants in terms of trying to chase people to get records. It's unfathomable.
Yeah.
And also, people don't want to be sending me stuff 4 times a year. They want to be running their business. They don't. They haven't got time for the likes of me, because there's money to be made. There are things to be done.
Yeah, this reminds me, Angus, of what you talk about a lot, which is the increasing professionalisation of the private rented sector.
Yeah, I mean, I think we will probably see more single property landlords drop out as a result of this. It'll just continue that, because it just won't be worth the effort. If you've got one property which is generating you, I don't know, 12,000 a year, so you're in the regime, you've then now got 5 tax returns to do instead of the 1, and you're going to go, it's just another nail in the coffin to the smaller landlord. And as we've got, we have a lot of portfolio landlords. I think for them, if they start getting the processes and systems in now, it's going to be an easier transition for them if they are properly accounting for each property, all work that needs to be undertaken on those properties so they can actually see the whole picture, then hopefully as we move into this new regime, it won't be quite as onerous. I mean, nobody's going to want to pay their accountant 5 times as much as they do at the moment. I mean, I'm sorry, James. I'm sorry, James, but you're just not going to get 5-fold of revenue. So they're going to have to find a better way of doing it than having an accountant who's doing 5 times as much work. So let's see what systems come in place. I have to. I've been giving some thought. Is there anything we can do in terms of Property Master to make life a bit easier for our customers to go down this digital tax route? Because we hold information on all their portfolios and rental and so on. So, are there things we could do to extend that and actually help them prepare for their tax returns in an easier digital way? So,
that's worth looking at. Yeah.
Question.
Sorry, James. Then we've got a question from Stefan, but you first.
Yeah, Stefan's question. You've got 3 buy-to-lets. It's going to be, you've only got to do the 1 return per quarter. So all of your UK property income.
What if they're in different sectors though? Furnished, unfurnished, holiday lets?
Doesn't matter. So the Income Tax Trading and Other Income Act, Section 263, just says exploitation of land in UK, one business.
So, but if you had a foreign holiday let, that would be a separate return.
Absolutely, yeah.
Is that on the quarterly regime, or will that be other?
It is, yeah. It is, but that is the only distinction at the moment that the Act makes. Is it in the UK? Is it not?
Buy-to-let and UK-based holiday lets are all on the same return.
So that's a good question. So a furnished holiday let technically sits under a separate regime within taxation. Why? Because there are very specific rules. If you meet the criteria, if it's available for enough days, if it's let for enough days, you get extra reliefs. You get some extra rules. Why? Because it's a pain. So you get extra relief because it's harder work. At the moment, it's not entirely clear from the legislation that came out yesterday. Putting my tax hat on, I would say a furnished holiday let is a separate endeavour. That's a separate business, surely. So that would be.
So at the moment, that's on an annual return.
Yeah, it is. And when we prepare your return, your sources of income as they are split down. So you have employment income, trust income, and you have property income, overseas property income, furnished holiday let income. They are 3 distinct sections. So I would expect the FHLs to be on a separate system.
Okay.
But so another set of returns again, but not clear from what came out yesterday.
But will the furnished holiday lets be on a quarterly system?
Oh yeah,
So you will end up having to report them separately from your buy-to-let.
But then what happens to service accommodation? Does that fall within the same regime, presumably? It's all a little unclear at the moment. But I would.
But if you're running some of these things through a limited company, it's different again.
So at the moment, it's a limited company. It's outside the regime altogether.
Well, that might answer Anthony's question. In actual fact, James, Anthony just put a question in the box. Not sure if you have answered this already. The 2024 digital tax change applies to limited companies as well as individuals.
Just individuals for now.
It's just individuals for now, but I guess watch this space, really.
It's because the government think we're the untrustworthy ones. They think the companies are trustworthy. They've got to file accounts.
But a lot of landlords now, if you're buying a new property, in many cases it's sensible to put it into a limited company for all the tax benefits that accrue there. But those are not going to be included within the quarterly reporting regime for property. They get reported as a limited company on an annual basis.
Yeah, it goes on a corporation tax return. At the moment, corporation tax returns not included within making tax returns.
Okay.
Well, that will hasten a further dash to limited companies, Angus, do you think?
Well, the challenge with dashing to limited companies is that you've got to go through a sort of sale and purchase generally, and therefore you've got stamp duty and any capital gains tax that arises from that to consider. So I don't think it will be a rush to it. There may be some situations where people start looking at how they can migrate in a controlled manner towards a limited company. That might be, which we've talked about on previous webinars. Some again, you're more the expert, James, in terms of moving through some form of partnership structure, legal partnership structure, towards a limited company.
Sure.
There may be some things for people to consider, but it's a several-year migration in terms of doing that, is my understanding.
Yeah.
Absolutely. So, but by default, if I transfer land and buildings to a limited company that I control, that I own, or someone connected with me controls or owns, I've disposed the property at its market value, so I trigger any gains, and it's regarded as being, as a company, giving me consideration equal to the market value of the property. So you pay stamp on the lot.
Yeah.
Regardless of the money that gives hands, exchanges hands. It's the one exception to stamp duty. Stamp duty is normally based on consideration.
Yeah.
What will I pay for the thing? There is potentially a way to do it by running a partnership first. There are some very, very complex reliefs under Schedule 15 of Finance Act 2003, which allow you to incorporate a partnership and not pay any stamp duty land tax on the way in. But there is an avoidance override for that. So if it's done too quickly, it can be thrown out. There is a particular tax case in 2013, I think it was now, the Ramsey case is known as, where a couple were able to claim what's known as incorporation relief. So they didn't pay any capital gains tax on the way in. But there were some very, very specific particulars around that. They were spending 20 hours or more a week managing the property portfolio.
Yeah.
They successfully argued that that was a business. So it can potentially be done. It's not without risk. It has to be done properly. And it relies on you having records to show that you've actually run a business. In the absence of those records, the thing is very, very much at risk, which I guess ties in quite nicely to making that digital generally, because it's all about keeping records, right? So,
Yeah, absolutely.
Yeah, so if you're going to be keeping records anyway, then anyway, it's. I think coming back to your question, Christine, I don't think it's going to see a major rush in terms of people moving existing properties into limited companies because it's because of the
because of the issues there.
Issues on the whole there.
But the thing's got to be costed out as well. You know, I mean, you've got to look at what the actual saving is going to be in the company, and then what's the cost of you putting it into there, and also how do we get the money out at the end. So dividends are just on 1.25% across the board on the tax rate. We've snuck that one in while with the furore over national insurance going on, with a much bigger tax rise going behind it.
I just got one last question here, I think, James, from David. If a property is owned jointly, then will the £10,000 threshold for reporting be applied to each party individually? So the joint income will be effectively 20,000, assume 50-50.
Yes, absolutely, yes.
Good.
Assuming you haven't submitted Form 17 to declare an unequal interest in the renting.
Yes. Okay, brilliant. Okay, well, I think we've picked up everything there. Fantastic. And we're almost getting into limited companies again, which I know is something we get asked a lot about, don't we, Angus? It's a huge topic. Well, thank you so much, James, for joining us and for sharing your expertise, and also sharing the news that we've got another year, and it sounds as if we're going to need it, really, from everything you outlined. And thank you also, Angus. Thanks, everybody. Just to confirm, we will send out a recording of today as well. We'll probably do that on Monday. So thank you all very much for joining us. Goodbye.
And see you next month.
See you soon. Bye-bye.